Hello and welcome to the Solutions Scoop. I'm Ravi Venkatraman.
And I'm Amanda Tepper. Ravi and I are co-founders of the Chestnut Solutions Institute, an independent forum dedicated to advancing the future of the investment solutions industry. Here at The Scoop, we examine the latest solutions marketplace developments and speak directly with solutions industry leaders. Our guests span the investment ecosystem, from OCIOs to asset owners, investment consultants, asset managers, and other key industry stakeholders.
These conversations are an important part of the Institute's mission to improve transparency and help establish standards and best practices across the solutions industry by educating asset owners, providers, and all other industry stakeholders. Let's get to today's scoop.
Welcome to our first executive conversation episode here at the Solutions Scoop with Lisa Shalett of Morgan Stanley. First, I'd like to introduce Lisa. She is Chief Investment Officer and Head of the Global Investment Office for Morgan Stanley Wealth Management. Lisa chairs the Global Investment Committee and has responsibility for managing the Global Investment Committee's discretionary models and outsourced Chief Investment Office, or OCIO, mandates totaling over $100 billion in AUM. Lisa is also responsible for Morgan Stanley Wealth Management thought leadership, publishing articles on topics of importance to practitioners and clients. Before joining the firm in September 2013, Lisa served as Chief Investment Officer of Bank of America Merrill Lynch Global Wealth Management. Previously, she held several senior roles at AllianceBernstein during her 18-year tenure with the firm, including Chairman and Chief Executive Officer of Sanford C. Bernstein, LLC, and served as Chief Investment Officer and Head of Alliance Growth Equities. Lisa holds a dual SCB degree in Applied Mathematics and Economics from Brown University and an MBA from Harvard Business School. She's a Henry Crown Fellow of the Aspen Institute and a founding member of the Financial Fellowship. Okay, let's get to my executive conversation with Lisa Shalett. So, Lisa, to get us started, could you share a little bit about you and your journey? Could you give us a quick outline of what got you from doing applied math and radio at Brown University, which is where you and I first met, to being CIO and head of the Global Investment Office at Morgan Stanley Wealth Management?
Sure. So, I always, whenever I talk about my bio, the very first thing I say is that I never, ever envisioned myself on Wall Street, right? I was an Occupy Wall Streeter before we're occupying. And right out of school, I was looking to really just work in businesses where I could use analytic skills to solve problems and work with clients where I had the satisfaction of knowing that I was helping them. That path took me in a management consulting direction that eventually I burned out of because I just couldn't do the lifestyle of that. That fortuitous decision actually ended up just pointing me towards a pretty unique opportunity to be a sell-side analyst at Sanford Bernstein, which for those of you who are kind of our age cohort would know was kind of the golden age of sell-side. And Sanford Bernstein was one of the storied independents where the analysts could really do research. And obviously this was before the regulated days of Elliott Spitzer. And so I just got phenomenal training as a research analyst. I covered industrials. I very quickly rose through the ranks there. I was the industrial analyst during the internet age. And so I wasn't necessarily the most popular analyst, which kind of created opportunities in themselves. And the biggest one was to become a director of research. And so I did that, and that gave me an opportunity to really train analysts and perfect recruiting analysts and really asking myself the question, what makes great analysts? And, ended up moving through a career at AllianceBernstein that included running the brokerage business, then moving over to the buy side and running a portion of what at that time was called the Global Research Growth Portfolio. And that kind of gave me a taste of managing risk. Went through the financial crisis. That obviously posed lots of challenges. And for me, the biggest challenge was seeing the transformation of the firm that I had grown to love, seeing many of my friends and coworkers displaced. And it was heartbreaking for me. And so I made a decision in 2010 to move into the wealth management business. I had spent the better part of my career in investment research, performance-driven cultures. And so I had the opportunity by 2013 to join Morgan Stanley and really be on the ground floor of building a CIO office here that, took advantage of the merger that James Gorman had executed between Smith Barney and the former Morgan Stanley. And it's been, a phenomenal decade really for me of just building and building capabilities, building models, building tools for our financial advisors and for our clients. And, the OCIO business really here at Morgan Stanley emerged somewhat opportunistically as a response to the fact that Smith Barney had a unit called Greystone Consulting. Greystone Consulting was beginning to face many of the issues that some of the traditional consultants were facing, which was a demand for discretionary and outsourced management. That coincided obviously with the exponential growth of complexity of products and the usage of alternatives, the need to have access to do the paperwork, to make capital calls, things that lend themselves to a discretionary model. And so really we entered the business supporting the Greystone consultants initially before, becoming a more full service OCIO provider attempting to serve clients in everything from DBDC all the way through foundation endowment.
Wow, what a ride. And just so amazing to be sitting here in the room with you today here at Morgan Stanley's offices on Broadway in New York City, back from Providence and WBRU a million years ago. Here we are, and our careers have had a number of parallels. I just want to say we were both sell-side equity analysts in the 90s. We both got stuck with industrials when everyone was doing tech and healthcare. And we both managed to parlay that into something. Then we both moved to the buy side of asset management. You recruited me to AllianceBernstein. You are my best boss, and I do miss working for you. But all these years later, when you were talking about being at AllianceBernstein, that heartbreaking time, that's when I was there too. That was really hard. And then you left to build this incredible thing that we're going to talk about today. I've been building too in my small way. That's when we started Chestnut. So I'm so happy that our paths are back in alignment. Great minds think alike, and here we are with the OCIO industry and investment solutions, which is really transforming the investment industry that you and I both started in those years ago. So here you are today in the wealth management division of Morgan Stanley. How does the wealth management business fit into the broader Morgan Stanley business? Kind of what strategic role does it play? How does your wealth management business differ from investment management, institutional capital market research, et cetera? That'd be really helpful. Thanks.
Sure. So look, I think the single defining attribute of the Morgan Stanley wealth management business is the fact that it is the business that gets generated for the most part through our financial advisors. And that sales force is our differentiating element. And so, when I think about all of the businesses that we've developed off of those relationships and the connectivity of those financial advisors, it's pretty profound. And so obviously the investment bank is serving pure corporate institutions. Our investment management business is really serving single sleeve solutions for the most part as a traditional sleeve provider to clients who are DIYing it. And so within the wealth management business, we're really sitting in that in between where we can provide services to quasi-institutions who have relationships that are disintermediated by financial advisor type client coverage, as well as leveraging individuals who have connectivity to institutions from the other end, right? So if we have an ultra high net worth client who sits on, a foundation board, they, can generate leads for us from that direction.
So you have quite a bit of what others would call institutional business.
Extraordinary amount. Yeah. I think one of the other things, Amanda, that a lot of people don't know about us other than our shareholders and perhaps those who follow our stock is, Morgan Stanley in our wealth management business really, pursued kind of a strategic transformational path about 5 or 6 years ago when we decided that the challenge for us, as good as our advisors were acquiring new clients mano a mano. And we made a decision that we were going to do some strategic acquisitions, some of which folks may know was the stock plan business, Canadian business called Solium, then ultimately combine that with the institutional businesses that sat behind E-Trade. A lot of people know E-Trade as a retail broker, which they are, but they also had an institutional business. And we're now the number one or number two, depending on geography, provider of cap table management, stock plan management. And that has given us a toehold into the C-suite. And taking those relationships has allowed us to, with one sale, suddenly have access to employees and beneficiaries, some of whom are C-suite, which ultimately become ultra high net worth clients, some of who may have executive compensation challenges that require advice. And then, of course, there are rank and file employees who ultimately grow into, mass affluent clients. So it's created this feeder model for us, and it's really amplified our growth. We don't necessarily draw the lines of, is an institution a wealth management client? Is it a MSIM client? Is it a bank client? They're a Morgan Stanley client increasingly.
Yep. That makes a lot of sense. So can you now give us an overview of what you, Lisa, and your teams, plural, because you have several reporting to you, do? And we've talked about the types of clients you serve. I believe all of your responsibilities come under, as you said, Morgan Stanley clients, the umbrella of helping those clients successfully achieve holistic investment goals. But there's a lot of pieces to that. So if you could just break down your team.
Sure. So look, what we've tried to do is build our global investment office as a foundation of all the capabilities that are required to serve a client mandate, whether it's the most basic client opening an E-Trade account who wants to fund a plan with an asset allocation for their IRA, all the way, to a defined benefit plan that, may have opportunities to defease liability through an LDI type mandate. And so what does that mean, right? What it means is that underneath my mandate, we have financial planning and all the tool development that really is the front end of all of our processes, because we fundamentally believe that cash flows should generate your asset allocation, not some non-normative, I'm aggressive, I'm conservative. So we have financial planning. We then have all of our asset allocation capabilities, which include my chairmanship of our Global Investment Committee. We then have what we call portfolio tools, portfolio construction tools, which is everything from our proprietary models on, active, passive by asset class to manager selection, analytics, to tools around tax efficiency, private equity pacing models, things of that nature. We then have, obviously, our due diligence and all of our manager and product selection capabilities. And then we have our solutions. And some of our solutions are more what I would call scaled or modeled solutions that are, typical of wirehouse competitors. But then we have our custom solutions, and the custom solutions businesses are really our OCIO businesses and our family office offering.
You're busy.
We're busy.
The organization piece is really helpful to hear, and I know your job didn't start that way, right? It's been developing over time, and we are seeing that across the industry now, because as solutions are exploding and we call it the parts, you called it sleeves, model is receding, it requires a different organization. So makes sense, everything you're talking about.
It does, Amanda. And, I think one of the things that we've observed is certainly within the walls of Morgan Stanley is there hasn't always been an appreciation that you really, in taking a holistic approach and taking a true solutions approach for the client, that all of these decisions are interdependent. They're not independent. Mm-hmm. And that putting things in silos, like saying, well, my manager selection unit sits over here and my asset allocation unit sits over there and my tools guys, sit over in a different geography with a different management team. It's really hard because, as you and I know, if we're really going to cook the recipe, we kind of need all the ingredients in front of us. Mm-hmm. And if we know that we're going to use a lot of, red hot pepper, we might not want to use chilies, right? Mm-hmm. And so it's a little bit of educating folks about this idea that true holistic solutions that work together need to actually be together and be coordinated and have points of integration, whether those points of integration are through investment committees or whether they're through more organizational realignment so that people are on the same page.
Yep. A lot of heavy lifting, I know, went into that. So now I want to turn to a question I know you and your team has been grappling with, and it gets to the heart of what makes an investment solution a true holistic solution and not just another investment product. Since all standardized investment products are designed to beat some agreed upon market index. So the Chestnut Solutions Institute defines investment solutions as all investment products and services whose primary goal is to meet the specific needs of a unique investor or unique set of investors. So now I'm going to quote back to you from your excellent report, which we're going to talk about on benchmarking. While beating the so-called objective benchmark of available market-based investment opportunities may feel good and may highlight the skill of a financial advisor over a particular period, and I would just add, may be really fun to tell your buddies about at cocktail parties, it still lacks the personalization that could define individual client success, contextualized through the lens of life goal achievement. In other words, getting you where you actually want to go, as opposed to boasting about some number. So here's the not really simple question. How do you and your clients and your advisors know whether or not you're on track to help them meet their holistic goals?
Yeah. So look, this has been a journey for us. And quite frankly, I think being in the OCIO business, maturing in it, building experience, building our institutional kind of DNA, and providing much more customized solutions that have to be tied to cash flow-based planning. As you know, if it's a foundation endowment, there may be particular spending goals. If it's a defined benefit program, there may be liability streams and funding ratios and quite other concerns other than did you hire the best large cap growth manager, right? And so for us, starting with that unique investment policy statements, starting with what is the goal, what are the types of asset allocations that you're probably going to need to get to that goal. And that isn't just about risk and return. It's about how much liquidity do you need? Mm-hmm. Can you take leverage? Do you need to have constraints? Are there value alignment criteria, whether it's an ESG or mission alignment or religious value? What is it? How does that constrain our universe? having to codify those things in investment policy statements derives these custom asset allocations. And embedded in those custom asset allocations are implicit return and risk and Sharpe goals. And, being able to enumerate that and redefine success as not, well, I was going to hire 12 managers on your behalf. They each have a unique benchmark, and oh, looky, 70% of them outperformed in the quarter. Well, that's fine, right? For what it really boils down to for our clients is, what do they eat at the end of the day? And for them to meet their goals, maybe they need to eat 6.9%, okay, with this kind of, volatility that's going to have this kind of annual yield, cash yield attached to it. That's success. And are we meeting that, right? And so, creating this idea of a custom asset allocation, which embeds by implication a custom benchmark, and judging performance holistically against that, because you're going to have puts and takes in any given quarter. We all know, why did we build the 9 style boxes, right? To have diversification so that when one outperforms, the other may be underperforming. Okay, but what's the net, right? And getting to the bottom line and giving clients that, here's your net. And your net may be different than that guy's net, because where that guy is, all he cares about, he may be in a super illiquid portfolio right now. All he needs to do is create a portfolio that gets him to a 4% draw every quarter. Like, can we do that? That's going to define success. Two very different things.
Right. So really, you're arming your clients to be able to say at the cocktail party, I'm ready to retire in 3 years like I had planned and sail around the world once a year.
And I don't have to worry.
Yep.
If the S&P 500 is up 23 and I'm up 21, I don't need to have an argument with my advisor that I underperformed by 200 basis points, because guess what? We built a plan that said on average you were going to earn 7%. The fact that you got 21, we are so in the gold. You got excess. You got excess cash to deploy. You good. You got a cushion.
So in the benchmarking report, which, by the way, is called What's Your Investment Benchmark? You talk about what you call the hitch and what we at Chestnut would call where the rubber meets the road, which is collaboration and iteration, because embedded in everything you said, so it's a more holistic, more integrated process of figuring out what the custom benchmark should be, what the custom plan will be. And then life happens. Then something exogenous happens in the capital markets, good or bad. Then something happens in your life that wasn't part of the plan you did 18 months ago when you first met with your Morgan Stanley advisor. So collaboration, iteration, you cannot do a set it and forget it approach. And the custom benchmark itself may need to change.
100%.
So can you talk about how you and your team work to help ensure that the solutions that you embark on work for your clients over what is often, ideally, from both sides, several decades, right, to achieving this hoped-for holistic outcome?
So we insist on revisiting the investment policy statement, revisiting the cash flow analytics every year. And we do that in concert with revisiting our capital market assumptions, right? Because those are dynamic. One of the things that we often talk about is modern portfolio theory is great. And we all talk about the efficient frontier and, 60-40 will get it done, 50-50 will get it done. But that is premised on this idea that the efficient frontier itself is stable. Efficient frontiers over time, over cycles, steepen and flatten. And so what a 60-40 portfolio might ideally return for a client in one environment is going to be quite different than in another environment. Now, we're in one such environment. In fact, one of our industry colleagues put out a pretty provocative report just this week that said, look, over the next 10 years, perhaps investment returns, given the level of valuations and the level of concentration in U.S. stock indices, are going to be subpar and might even be below 5%. Not something that the average institutional investor is going to want to hear, but there's some logic to it. And it's exactly that type of logic that we want to revisit with our clients every year and say, hey, we've now had 2 years of back-to-back up 20, 25%. What are the odds that that's going to be replicated? Maybe low. So maybe our efficient frontier isn't as arced and up and to the right as we thought it was. Maybe, in fact, it's kind of flattish, and we need to revisit asset allocation, which means we revisit the benchmark. That maybe having a benchmark that says you have to earn 9%, guess what? Maybe you could have one that says you earned 5 this year. Because, oh, by the way, you're so overfunded, right, the last 2 years. You're so far ahead of where you thought you'd be. We can de-risk a little bit and be okay with 5. And that's our new benchmark.
And do you get questions back or pushback on, especially as you get to the quasi and full institutions who are in large parts still governed by folks who came up as you and I did in a different regime that was more stable, that was more aligned to parts and standardized benchmarks? Wait, I just wrapped my head around this new custom benchmark, and now it's 2 years later and you have a new custom benchmark. Are you playing a shell game with me, or did things really change? And how do I still know I'm doing well? How do you handle that? Because that is the inherent conflict in all of this customization.
It's 100% the inherent conflict, right? So this has been a process of continuous education for us. And sometimes it goes slower than you'd like it to go because, of course, institutions have their constituents, they have, their beneficiaries, they have their stated mission and goal statements that sometimes say, here it is, we're here to generate 8% or whatever it is. And that's what we're doing. And, hey, Morgan Stanley, you want to work with us? This is all very nice. Sounds very smart. Thanks for entertaining and educating us. But can we get back to business because we need 8%? Mm-hmm. And so it's a journey, but it's also about showing through the cash flow statements and using and borrowing some of the tools from that you learn with all your different clients, right? So, for example, funding ratios as a concept is something that historically the defined benefit oriented clients were very well acquainted with. Well, take that concept to a foundation and endowment, right, which always views themselves as on perpetual money. Mm-hmm. Well, now think about how mind-blowing it is for them to say, look how well funded you are versus what you just set out. We may not think you can do 7 next year or 8, but you've just done like 3 back-to-backs, 16s. So just how funded are you on this path, on your journey to wealth creation, wealth preservation, right? So that's an example. We will change some of the analytics that we present to help educate. Another concept and another analytic that we're using is what we call risk capacity. How much risk capacity do you have? Sometimes we get locked into this idea of we can't take any risk. Well, if you're amply funded, maybe your risk capacity, right? If you're still assuming in the long run, I'm going to make 7, you, instead of de-risking, you now have options to risk up and showing both scenarios and saying, okay, as a board, how do you feel about this? And which do we think is most prudent given our outlook? So there's ways of making the conversation dynamic. You just got to be willing to do the work, the illustrative work, to bring people along.
Right. And then there's one last, actually there are many more pieces, but we're not going to stick on this topic forever, but there's one really important piece that comes up a lot, especially with certain types of institutional clients, which is not so much the publicly traded, well-known, media-covered benchmarks, but the annual rankings of the returns of some peer universe who are all doing apples, oranges, and pears, right? And the board will for sure be hearing from all sorts of constituents every year, wherever they are on that list. How do you approach that part of the conversation with those clients?
Yeah, so that's a tough conversation to have because, peer benchmarking for many of these institutions is it's just a fact of their life, right? And so we have to kind of have respect for it, and we have to actually have knowledge of it. I mean, that to me is one of those things that when we're building your investment policy statement, when we're thinking about these assets, we also say, look, what are your metrics? Right? How are you as a board going to be measured? How is you as the CIO going to be measured? And, if they say, hey, we need to consider this peer universe, or we're a mid-sized university and we're always going to have to look at the NACUBU, or we're always going to be benchmarked to X, Y, or Z, we're going to have to be mindful of that and present the underlying cash flows of what is a typical mid-size endowment doing. And here's what that would look like if you just wanted to choose that path. Does that make sense for your cash flows? Could you do that? It's not unlike the conversation that you sometimes have with clients about active passive, right? They want to argue, well, active doesn't add any value, and say, okay, but remember, choosing not to have active management works both ways. Yes, you won't underperform, but you also won't outperform. And that means in a downturn, you get 100% downside capture. Pick your poison. Pick your poison. And so a lot of, what we do is just model these scenarios and just say, let me show you what that looks like. I hear you. Let's talk it out. What's going to be the best thing? What's going to give you guys the sleep at night? Because to me, and part of this, and maybe I'm too old or too jaded, but we've kind of learned that what it means to manage money holistically is that there may not be one right answer. That managing money holistically includes you're doing what your client asked you to do. That's not to say if they ask us to do something that doesn't have fiduciary fidelity to it, we're going to do that. But they've got to sleep at night too. And so that's part of what we mean.
Collaboration and iteration, right? It keeps going back to that. So now let's talk about how you and your team actually build the portfolios. How do you create and deliver these holistic solutions to your wealth management clients? What's your process to build and manage these portfolios?
So again, I can't emphasize enough, we start with cash flows. So we're doing, typically 10, 15, 20-year cash flow modeling, resulting in, underlying asset allocations. We will show those, to a client. We will zero in on an asset allocation. We will then, the next step in our process is for each asset class, we have a recommendation about active passive implementation, but they may have a constraint around fee budget and how they want to spend that fee budget. If there's a min, there's a max. If they only want to spend it, on the private side of the portfolio or the illiquid side of the portfolio. So we will make those decisions. We'll then have recommendations for where we need active solutions, who our preferred managers are. Again, have that vetted, and then create an implementation program or prescription for getting fully invested. A key part for our clients that do have alternatives is what we will do, because that's the part of the portfolio that perhaps we can't liquidate or can't change, is we'll do deep dive risk analytics right from the get-go. We'll say, here's what we understand that you own. Here are the risk constraints for us to manage around it, right? So if, you have this huge slug of venture capital, it's kind of sitting there. We don't know exactly what the value is, but we know it's levered or tends to have a beta levered to tech. We're going to take that into consideration and therefore perhaps, not give you a full weighting to U.S. growth equities. You already have that beta somewhere else in the portfolio. We will also do a lot of cash flow pacing. We don't while we are advocates of using illiquid investments in portfolios, we are not advocates of mismanaging cash and having massive cash drag simply to meet capital calls. And so we try really hard to plan out what we think, based on our experience and history of the timing of capital calls, the size of capital calls, and how that might array versus distributions. Obviously, our goal for most of our clients is to get them, to a self-funding privates program where distributions are funding capital calls, and we walk them through that.
So let's talk about alts and how critical they are. Let's dig into that a little bit more for a minute. I know you guys do a lot of work on that. And you talked about clients who have alts, meaning they're in their current portfolio that they're transitioning over, they're bringing some heritage stuff that is illiquid that you have to manage. How about those that don't have it, and how about the mass affluent, which is a huge part of your business, and where's Morgan Stanley and your team, and how do you think about that? What are you doing to bring it to all your clients, to the broader market?
Yeah. So it's interesting. I think there's been a huge amount of both education, right, of both the mass affluent and the high net worth space, as well as the institutional space on alts, on the illiquidity premium, on wanting to be there and the outperformance. I think more recently, as private equity, venture capital, private credit have gone through the cycle, in certain cases like private credit are starting to mature, I think that more seasoned investors are starting to ask questions, right? They're starting to ask the questions, well, how do the marks get taken? And why did I used to get marks once a year and now I'm getting them, once every 18 months and things of that nature. And that's created an opening, as is always the case in our ever innovating industry, to create more liquid, more transparent, more democratized versions of these products. And what we're finding is that, again, for certain client segments who lack the patience, the sophistication, and quite frankly, may even have done some of the analytic work to understand things like cash drag, to understand that there's a big difference between IRR and total cash-on-cash returns, that perhaps some of these democratized vehicles are a better option for them. That perhaps, if I'm in a perpetual vehicle, not only do I have some liquidity, but I can put a valuation on it, and I don't have to sit and have these denominator effect debates at my investment committee meeting. And I can have more security about the timing of when my cash is getting put to work, and I don't have to worry about cash drag, all these things. And so, look, I think, for us, we're starting to really look hard at, for clients that don't have exposure, is a quick, easy, clean way to get them somewhat diversified by vintage and by subsegment using some of these more democratized products might be okay, and without a ton of return, cash on cash return give up. And so that's, I think, one of the tools that we're finding that we can use.
Yep. And more to come, right? It's constant.
I mean, I marvel at our industry that nothing seems like, okay, you've got the silver bullet. There's never a silver bullet.
So you spend most of your time, most of your days meeting with Morgan Stanley's clients, right? Talking with them about their portfolios and the markets. So other than benchmarks and custom benchmarks, what are a few key issues that you keep hearing from them and you keep coming back to these days?
Yeah. So look, I think for most of our clients, the issue over the last 3 to 4 years has not been returns. Right? So the issue for them has been, I do have potentially access, right? Risk capacity. Should I be going into more privates, right? I see that this peer group is at 30 and that peer group is at this and I'm at this. So there's debate about that. There's a lot of discussion about, well, is now a good time, right, when many of these funds are not distributing and haven't fully adjusted marks? Is now the good time? Is this a good vintage? Is this a bad vintage? Are we in between, right? Is this opportunistic or am I late? So we're talking to our clients a lot about that. We're also talking to clients about, And this is a little bit, I don't mean to get into market talk or pure investments, but, this concept of American exceptionalism, right? This idea that, okay, Lisa, very exciting that you want to give us this diversified asset allocation, but can we just get real? If I look at my analytics, going back for the last 15, 20 years, why would I ever want to own anything other than U.S. large cap growth stocks? Why are we even having the discussion, right? And so I think that
They forgot '08.
Yes, they forget. Investors forget, right? And this mythology around America it's global. I mean, I just came back from London and I was horrified at how the Europeans are. And I'm like, okay, guys, I know we can all, talk about our own dirty laundry in our own homes and our own countries, but really? Like, it's a really expensive market. It's at record levels share of the MSCI world. Everyone and their mother's overweight. We have this massive potential political, shift about to happen. The U.S. dollar could be entering a period of structural secular decline. U.S. interest rates may be entering a period of secular increase. Seriously? Like, this is you think this is the only game in town. But getting people off of that is we're spending a lot of time on it.
There are geopolitical concerns, there's rates, there's soft landing, hard landing. And I know you've made some tweaks recently. Anything kind of near term that you want to add before we wrap up here?
Look, I think the only thing that I'd add is in these conversations about asset allocation, I think one of the few where we may be agreeing a little bit with the naysayers is around U.S. small cap. And we're doing a lot of work on this, but we're increasingly asking ourselves if public small cap equities in the U.S. have become structurally disadvantaged. Whether you're talking about the effects and the power of technology and scale, combined with the lack of regulation that suggests we're in a world where the big only get bigger and that small companies are structurally disadvantaged no matter what the interest rate is, right? Or whether you're talking about this idea of adverse selection, where the exponential growth of the private equity dry powder has literally picked over the small cap universe, so that, here we are in an environment where nominal GDP growth in the US is a very healthy 5.5%, and you have 45 to 60% of the small cap universe in any given quarter putting up an unprofitable quarter, which you have to say to yourself, like, holy cannoli, like, these guys can't make money in an environment where U.S. unemployment is at 4 and U.S. nominal GDP is 5.5. Yes, interest rates are higher than they were, but like, holy gosh, what are they going to do in a recession? Mm-hmm. And so we're asking ourselves, look, if you want to invest in small companies, should that allocation that we used to give to small cap, should that just go to your private equity allocation? That's just a better, safer way to invest in the higher quality parts of that cohort.
Yeah, that makes sense. It's a structural change in the markets, and that may be probably is already coming on the debt side as well with private debt, which would be another conversation for another day. So, Lisa, thank you so much. Thank you for joining us. Thank you for your support of the Chestnut Solutions Institute, and thanks for sharing all your thoughts with us today.
Absolutely. Thank you, Amanda. The industry is benefiting from what you and Chestnut are doing. I applaud it, and I'm so happy that I call you my friend.
Thank you. Me too. Thanks so much.
Chestnut Advisory Group is a boutique, practitioner-led management consulting firm dedicated to asset managers and investment solutions providers. In addition to the Chestnut Solutions Institute, our advisory practice areas include distribution strategy, M&A support, go-to-market, and implementation and coaching services. This podcast is owned and produced by the Chestnut Solutions Institute. If you like this content and would like to access more insights, webinars, and podcasts, please check out our website, chestnutadvisory.com.